Guys, I get a lot of people that ask me this one question. They say, Dave, how do you take advantage of big shifting markets and big swings in the market like this when you have the Dow, the Nasdaq, the S&P 500 going up and down 3% on a regular basis? So I want to show you guys this special strategy. So today I want to talk to you guys about straddles. How do they work? What do they do? And how do you profit from them? When is a good time to use a straddle? A straddle is simply buying a call and a put at the same strike for the same expiration date. So let's say we expect this volatility to continue this week going into election. I don't know what the market's going to do tomorrow. I don't know if we're going to have another 800-point sell-off. I don't know if we're going to rebound 500 points, but I think the volatility is here to stay and I want to profit from it. So a great strategy to use is something called a straddle. And a straddle is simply buying a call and a put for the same strike. So you'd buy to open and you would buy to open and you'd buy one call, one put, same expo date and the same strike price. So if you're buying the call and we're at 337.67, we'll use 338. Okay, and then the same thing for the put side here. Okay, so what we're doing here, you're buying a call for this week's expo. So we go to the 30th and we say we want to buy a call and a put on the 30th. Okay, so now you can see the call for October 30th, 338 strike put. It's going last traded at 388. Okay, and for the put for the October 30th, 338 strike, it's going for 419. So now what you're going to be doing is you're going to add these two together, okay? Because you're buying a call and you're buying a put for the same expo, same strike, okay? And you're only doing this type of strategy when you're expecting big volatility or big moves in the market like we're seeing today. I mean, the markets are moving 3% today. The last time we saw that was during COVID. And you guys remember the big 1,000-point swings up and down during COVID. And we did our best trading during COVID, right? So now let's add these up here. 396, 3.96 plus 4.09. So that means this is going to cost us about $8.05 for this option. Okay, so then what you would be doing is putting in a net debit limit order and you'd be putting in 8.05 in a day order. So that means if you got one contract of each of these, it's going to cost you $805, okay? Now here's the thing. So what happens? How do you make money? Well, look at this. S&P SPY's down 8 points today, right? So as long as you're making enough money to cover the both costs of the call and the put, you're going to do well. So now if we have another pullback on SPY tomorrow and we drop another 3%, it was down 10 points today. So if it dropped 10 points tomorrow, the call is going to be, that's going to be cut in half. We still have the IV there from the implied volatility, but now that put is going to be worth $10 more. Okay, so that's going to make up for the cost that we paid the $8.05 for. So if we had another big pullback on SPY like we did today, and we have another 8 to 10 point drop, we're going to have big gains on our puts, and our call side's probably going to lose about 50%. So that's how you use a straddle when you have that volatility there. And remember, that's just one day. So then you could go ahead and either you could sell that put there and lock in those profits tomorrow or the next day if you want to hold it. And then you could hold on to that call side and say, okay, now we're going to rebound since we had 2 days of almost 1,000-point drop, and then hold on to that call side and then sell that call side on the third, fourth day. There's so many different strategies you could do. But with a straddle like that, that's the nice thing about this. No matter what, as long as you get that volatility, you're going to make some money with that straddle. Well, look at the size of these candles compared to the last 4 candles. It's literally about 4 to 6 times the size of these other candles here. So when you have that volatility and you're jumping into these straddles here, Obviously, one of them is going to be a losing trade. One of them is going to be a big winning trade if you get that volatility. So that's what's nice about that. You don't have to pick a direction, but you could say, okay, I'm not sure if we're going to rebound tomorrow or if we're going to continue this sell-off. So a straddle might be your best option. Like I said, your break even on the call side is going to be $338 plus $4. $338 plus $4, that's $342. Anything above $342, you make money on the call side, you know, and then the put side starts to lose money. Now, on the put side, 338 minus $4, what's that? 338 minus $4.03 there, so about 334. So if you break below 334, then that put starts to make money. So that's a quick example there of how straddles work, how you can make some money from them. So hope that helped, and that's a great strategy any one of you guys could use on straddles.